Welcome, everybody, to our quarterly podcast, House Views with Park Madison. And today's guest is Jack, who is a principal with Park Madison. So, Jack, welcome to the program. I know you guys just published your mid-year outlook, and so we're going to talk a little bit about that. But at the start of the year, you had a constructive but cautious outlook. What's changed by mid-year, and what's held up better than expected?
Yeah, great. Jeff, thank you for having me. It's a pleasure to be here. I've been a huge fan of and supporter of IREI and you over the years, dating back to my consulting days with the Townsend Group. So always a pleasure to talk and spar and trade ideas. So looking forward to our discussion today. So once again, thanks for having me. Yes, we produce an outlook at the beginning of every year, and then we've now started updating that halfway through the year to try to give ourselves a, if you will, a scorecard on how we're doing. I think our mid-year review is a polite way of saying that the market had a few footnotes potentially on what our January optimism looked like. So. Maybe to set the stage, if you don't mind, maybe we can talk a little bit about fundraising first, and then that sort of sets the stage for many of the other things that are in our outlook, if that works for you.
Go for it. I mean, I meant to say at the outset, the reason we're doing these podcasts is really to give the market, all of the people tuning in, the opportunity to really understand what's happening out in the market, because placement agents like Park Madison are talking to investors every day, talking to consultants, and they're much more likely to pick up nuances that are happening as they're unfolding. And so we thought by sharing it with the audience, it really gives you a great perspective and gets you some insights into what these placement agents are seeing. So go ahead, Jeff.
Yeah, that's great. That's exactly right. Jeff, when we sat down in January to really frame our year ahead, we were coming off one of the best fundraising years since 2022. So 2025 was about $128 billion of total capital raised. That's the third best on record and a significant increase from prior years. So we sat there and we thought, great, we've gotten through a lot of the market uncertainty. We've come through COVID at this point. Certainly, we've come through the interest rates, changes, et cetera. And so we should be on the heels of this strong year. We should be in a pretty good place. Well. That came to a grinding halt with the Iran war and other factors. So the first half of 26, we're down 38% year over year from the first half of 25, and that's the lowest first half since 2017. So certainly weak in absolute dollar terms. However, I would say that it's a little bit skewed and distorted if you're just doing apples to apples against 2025, because the first half of 2025, both Brookfield and Blackstone were in the market. So you had these mega funds that did gobble up about $35 billion of the total capital raised. So there is certainly a little bit of a distortion there, but generally speaking, still, down. I would say despite that weak headline total, the fund quality and execution is a little bit better. And I mentioned that because about 70% of the funds closed in the first half of 26 either met or exceeded their targets. And that with at least 8 of the 10 top funds hitting above their targets. So the quality of the managers and their ability to ultimately raise that capital is showing strong improvements. And that's a market improvement from other years. If you look back in 24, I think only 63% fell short. And in 2025, 45% fell short of their target return. So generally speaking, we're in a much better place when you look at the quality of the managers that are out there and the ability to actually hit their targeted returns. The one other comment I would make is that fundraising timelines have also improved. So in 2024, we hit a peak of over 24 months from the first close to the final close. This year, we're down to 18 months. So certainly a better and an improving overall environment when it comes to fundraising, given the quality of managers, et cetera. Now, capital is still hard to come by, and fundraising isn't easy, and we can talk a lot about that, of what's impacting that through this conversation. But really setting the stage for our market outlook. was a strong fundraising environment for the year, given sort of the capital that the year that we had come off of. But now a little bit of a reality check, candidly, on how it's been thus far in the year.
And what's been attracting capital? What kind of strategies have investors been responding positively to?
So I think generally speaking, and it's probably been a shift over the last 7 to 10 years, I would say, and really dating back to my consulting days, is that the allocator funds, the mega funds, certainly the Brookfields, the Blackstones, the large funds, still always be sort of a core piece of investors' portfolios. I think what's changed is that the vertically integrated specialists really do continue to gain momentum, and it's for a myriad of reasons. The lack of a double promote, but really a specialist being on the ground, boots on the ground, understanding their property type and understanding their geography, if you will, in many cases. I think the alternative property types have also gained a lot of momentum, whether that be industrial outdoor storage, whether that be medical office, whether that be manufactured housing, self-storage. Things like that have and continue to gain momentum. And the conversation, so you mentioned before, we're out talking to, call it 2,500 active LPs on a regular basis. And this mid-year outlook is a very nice time to check in with a lot of those LPs to see if things have changed from their perspective as well. But many of them are looking for more of the complement to their existing portfolios. So manager rosters within portfolios are pretty strong right now. There's been a lot of, I've got my baseline of managers. Generally speaking, most have performed pretty well. So trying to find a way to include a new manager into that roster, if you're just a simple vertically integrated multifamily manager, and to displace an existing manager is quite difficult. I think I just spoke to a consultant that told me they had 50, just to use this as an example, 50 vertically integrated multifamily managers of institutional quality that they were tracking currently in the market. So to displace somebody is very difficult given the opportunities that investors have. So where are they spending their time, and what are they talking to us about is how they can complement their existing portfolios. And in many cases, that's a little bit of these alternative property types that really can provide a slightly different execution or complement to their existing portfolios. As I said, to their industrial portfolio, it could be cold storage, it could be industrial outdoor storage, it could be within office, it could be medical office, it could be creative office, things like that really that are resonating from our perspective.
So when you're looking at those kind of strategies, is it just the fact that they're different than what people have traditionally invested in, or do they bring certain attributes that are missing from the portfolio?
I think in many cases they bring different attributes, right? If you think about an industrial outdoor storage strategy, this is a strategy that historically was buy by the piece and sell by the pound, right? So you're not just you're looking for that portfolio aggregation to ultimately result in a portfolio premium at sale. So instead of selling one-off based on a one-off by one-off by one-off, it provides a slightly differentiated strategy to the overall portfolio because of that, right? The traditional maybe buy, fix, sell this multifamily asset, but in industrial outdoor storage, we're going to buy, ultimately create a portfolio and ultimately recognize a portfolio premium upon sale. So there is nuances to the overall strategies that investors are looking for to complement. So it's not only property type, but it's also strategy in that sense of what I just described.
So what is going on in the area of recaps and continuation vehicles and secondaries? There a lot of activity there, and if so, why?
Yeah, there's been a tremendous amount of activity, and so if you look back, GP-led recapitalizations really solve a couple of issues over the course of the past years. What we hear from LPs is, I need capital back in order to make new commitments, in order to unlock new commitments. Because of this transaction volume sort of freeze that we've had over the course of the last couple of years, investors don't have a lot of new capital to redeploy. So what did GP-led secondaries do? They solve a couple of things. They can bring in a new institutional partner that does have capital. They can provide liquidity to those existing investors. So those investors that are asking for capital back, that provides an ability to do that. It refreshes a business plan for the GP. Maybe they have more business plan to execute. They don't want to necessarily force a sale. They recognize the opportunity to continue to grow the overall return for this particular asset or portfolio. And lastly, it provides fresh capital to add on to that portfolio. So it really does provide a solution now to investors. So if you look back, real estate secondaries transaction volume hit a record 20 billion in 2025. And so GP-led recaps represented 72% of that total. And that the overall GP volume has grown 25% since 2018. So the reason I mention those stats is because this is not simply a niche workaround anymore. This is it's becoming a mainstream capital formation tool and capital execution tool for both GPs and LPs. GPs in order to potentially continue the business line or continue the business plan, and for LPs to ultimately either double down, if you will, on the overall strategy or receive their capital back. So we definitely continue to see GP led secondary strategies, and we'll use that loosely from a secondary strategy because it could be GP, it could be LP, it could be multiple iterations. But you're definitely seeing that as top of mind when you talk to LPs about what are they looking for in there to complement their existing portfolios. And there's a lot of those current strategies out in the market. I think there are 12 or 13 currently being raised in and around on a global basis, targeting different niches, but largely 10 to 12 of those in the market today.
I notice also that, on the news streams that are floating across my desktop, we're seeing a lot of activity in terms of capital fundraising for secondary funds from IREI, from Partners Group, from I think Townsend just had an announcement just recently about a big fund closing. So
that's
that
exactly
certainly is suggesting that there's real opportunity there.
Yeah, there is real opportunity, and as I mentioned, that secondaries transaction volume hit 20 billion last year. So there's that momentum continues for sure.
Now, data centers are a hot area of the market, and they continue to be one of the most highest conviction sectors. But what's the more nuanced story there? I mean, beyond just AI demand is strong, which everybody talks about.
Yeah, I think the more nuanced story is that fundamentals remain exceptional. I think that is, but the real differentiator now is really power, it's exit liquidity, and it's where really in the data center ecosystem you are investing. So demand is still outrunning supply. I think in the original outlook, vacancy was around 1.5% at the beginning of the year. And then after supply grew by 45% in 2025, I think JLL just showed that data center vacancy in the top US markets is below 1%. So if you look at that and you say, wow, that is an extraordinary supply demand imbalance. And at the same time, it's not that supply is just constrained by capital, it's constrained by that electricity and power. Historically, the path to power, quote unquote, was somewhere between, I think this was a data point as of 2 to 3 years ago, was somewhere around 12 to 18 months. Today, it's about 36 months. So that means, if you think about it, that the owners of the existing powered assets that are already built, already operating, they really should enjoy a meaningful pricing power. And that it also means that the market should reward investors who really understand the distinction between a hyperscale development, which is going to take time and going to need to obtain that power, and ultimately the co-location facilities, for example, that may already be in existence and are already operating and have the power, and the carrier hotel type data center exposure. So really, it's nuanced, but the overall supply demand is certainly there. What I think is important, though, is that when you talk about data centers, Jeff, and this could be, I don't want to get too political by any means, but it's becoming a political hot button, right? By all means. I think that in the mid-year review, we noted that 20 planned data center developments that were canceled in Q1 of this year, and strictly because of a moratorium that was placed on either the municipality or at the state level. I think we saw just recently last week, New York State announced a moratorium on new data center development while they went through data analysis, et cetera, to really figure out the impacts. And so you're really beginning to see a trend of this NIMBYism, this not in my backyard. I think the recent stat that I saw was that 71% of Americans would oppose a new data center project in their area. That's a high shift in what it was previously. I think back in September of last year, it was about half of that would have said, I don't want a data center in my backyard. So it definitely is becoming a political hot button. But the reality is that if you look at the cost benefit analysis, I think if you look at Loudoun County, for example, data center, that stat that I just saw, 4% of the land is used for data centers. But it contributes over 40% of the property tax base. So they're real. Well, the politics are real. The economic value is certainly there too. But it continues to be interest. I know I recently spoke with an investor that had 15% data center allocation. They want to grow to 25%, right? So you continue to see on a risk-adjusted basis, the return is very strong, and that it certainly is a trade-off. If the time is going to take a little longer to get the power, et cetera, investors really need to think about that as they ultimately do continue to invest in the sector.
On the major 4 food groups, industrial's been the hero over the last couple of years. Where do you think the next cycle's winners separate themselves from the pack in that sector?
Yeah, I think the next the next cycle will be much more selective than the last one. Broad-based, if you talk to investors, and a lot of them have a significant industrial exposure now. And that initial boom of, wow, I'm underexposed to industrial, I'm now probably overexposed to industrial, that ship has sailed. But that big first investment boom is probably behind us. I think the next, what we talk about and where our investors talk about, is the winners will now be assets and operators that are likely aligned with automation, power access, and infill or specialized industrial or logistics type of use cases, if you will. And so so generally speaking, in industrial, maybe take a step back, net absorption is up 36% year over year. Vacancies appear to have peaked at 7%, and about 40%, let me have the stat right, 40% of current construction pipeline today is built to suit. So those are signs that the market, in my mind, is really beginning to rebalance in a constructive way. So now what really differentiates, and I think now it's that functionality that I just mentioned, and so automated warehouses consume nearly 10 times that of a regular warehouse, of a traditional logistics facility.
10 times the power.
10 times the power. And so what you're now seeing is competition from the data center developers is increasing the scarcity value of those powered industrial sites. But those powered industrial sites, as onshoring becomes a bigger part of the industrial ecosystem, and folks doing some type of automation in their industrial assets, you're seeing that need for power to be greater and greater and greater for a simple logistics warehouse facility. And so really having that access to power, in our mind, is going to differentiate some of the winners and losers to a large degree. I think, generally speaking, that you're also seeing a lot more underwriting being focused on the operating platform, and those teams' ability to really squeeze the last juice from the lemon, if you will, and where those groups can really exercise. Do they have a specialty in and around the Boston area? Do they have a specialty in California? Where do these groups really differentiate themselves? So the operating platforms are really going to be analyzed to a much greater degree. It's not simply I'm going to invest in industrial and take advantage of this e-commerce boom and last mile. It's really going to be, is the manager that good at really squeezing the value out of these assets and is positioned in the right geographic locations.
Yeah, we conducted a private roundtable with our sponsoring firms, researchers yesterday, and one of the points that they raised is that there seems to be a bifurcation in the industrial market right now between newer product and older product in terms of lease up. That it's really hard to lease up older product today, but lease up on the newer emerging product, like you just described, is really robust. And take up is happening really rapidly.
Yeah, that's the exact same, those same stats and anecdotes that we've heard as well.
Yeah.
But again, this comes down, And sorry, this comes down once again to where as I mentioned at the beginning of how are investors differentiating their portfolios and thinking about portfolio construction. It's really the complementary aspect. Okay, I have broad-based industrial. Where else can I get some industrial exposure, but is going to differentiate me? And it's exactly in this automated or powered shells that may not be data center quite powered, but are powered enough so that I can do some robotics or automation or things like that in my industrial facility.
We've also heard, just to veer off for a second from kind of our agenda here, we've also heard that there's been a lot of talk about big funds like CalPERS kind of moving away from the traditional strategic asset allocation model to a total portfolio approach. Are you seeing this happening more on a widespread basis? And what are the implications for people that are trying to raise capital?
Yeah, we are seeing it. I think North Carolina just announced it as well. Brad Briner down there, and so we are definitely seeing it. I think that it in CalSTRS, I believe Jeff has been doing it for a number of years. This wasn't a recent switch. I think it's gained a little bit more public notoriety around it that they've been using this total portfolio model for a while. It certainly is going to impact. It's going to impact the traditional real estate, if you will, because you're going to be comparing and contrasting against all other asset classes. Now, that said, I think it also benefits real estate and how real estate brings real estate really back to its roots. What is real estate? Durable income with a cash flowing asset in an irreplaceable location, and typically inflation and having inflation protection attributes. And so it may help real estate, and I'll say it may help us in the real estate industry, have to not compete necessarily against that venture PE strategy that's out there that's going to be a 5 or 10 times multiple, where we say, okay, we still need the barbell approach here in our portfolio and having some safe income producing assets or safe income producing asset classes. So it is certainly going to change the way that we may need to express the strategies and why and the attributes of a particular strategy. But in general, there are some positives in my mind and maybe I'm biased, right? We live and breathe this every single day, right? But real estate is a cash flowing property. It's a cash flowing asset class. And at its root, it's income oriented. And so hopefully that does come through as a barbell approach to some of these other strategies when they're sitting around the table and deciding what's the best for the portfolio today in these total portfolio models.
Switching back to property types, rental housing still appears to be relatively favored, but your mid-review seems to suggest that more selectively than the broader market narrative might suggest. Where are you guys most constructive and where are you most cautious?
Yeah, it's although we still remain constructive on rental housing, and that when you speak to LPs, it's housing, it's industrial, data centers are really the top three that are what do I want in my portfolio? Where am I looking to expand my concentration in the right or exposures in the right strategies? So when we come to rental housing, though, we're still constructive on it, and that really is for the affordability pressures, the durable demand. And how much better today the future supply picture looks, but it's no longer really a one size fits all. The dispersion on vacancy and ability to push rents is great. I think I saw a stat that said in this was back in May that New York City, for example, had a 2.8% vacancy range or percentage, excuse me, and San Antonio was almost 16%. Right. So I just use that as the vast delta between geographies and between micro markets, if you will. So, in supply constrained markets, fantastic. You have the ability, for example, where vacancy remains low to really to push rents and where rent growth has been strong. But we are certainly more cautious on markets where there has been overbuilding and supply. I think the other side of this is looking at other complementary rental housing strategies, and could that be manufactured housing, for example, where that really is workforce housing at its root. It's performed exceedingly well over the course of the past cycle. You have great income, particularly great tenant stickiness, particularly with the home. If you look at the tenant home owned model, where the tenant owns the home and they simply rent the manufactured housing pad. Those are very, very attractive strategies and provide strong diversification from a traditional rental strategy. Additionally, build for rent has now come back after we've gotten through the bill process in Washington. Purpose-built centers, communities are allowed, if you will, again. And so that provides another interesting way to complement housing. But once again, it's a supply question, and it's definitely you need to keep it's a micro market selection that investors really need to keep their eye on, and that's top of mind for the investors that we speak to. As I said before, traditional vertically integrated multifamily managers that are building, the garden style in the Sun Belt. There are 50 of them currently in the market, and so the competition is real there. And to really diversify, or to really provide a competitive advantage against your peer, you really have to have something differentiated to do that in that space. And so we think that there is tremendous opportunity in sort of a little bit more of these complementary strategies, whether it's BTR or manufactured housing, in addition to those traditional strategies.
Now, the bloom has been off the rose for office for a long time, until recently, when we're starting to hear green shoots because of AI. Do you think the office recovery has legs, and if so, why?
Yeah, I mean, it's still early, and it's been very selective from comments that we hear among our LP base. I think if you still go to LP and talk to an LP and say, is office on your hit list for this year, most of them are going to say it's a very low priority. But having said that, to your point, it's there. We are seeing some green shoots. Mid-year at our mid-year review, data showed that net absorption is at its highest level since the pandemic. Vacancies are no longer really rising, and the total U.S. office supply has shrunk by about 25 million square feet since 2023. And that's due to limited new deliveries and also the inventory removals, whether complete obsolescence or office being converted to multifamily or things like that. So, AI will definitely impact and reshape workforce, the white collar workforce. And then but the thesis really then has to become a supply thesis. So if you think about in Midtown Manhattan, around Grand Central Station, north and south on Park Avenue, vacancies there are exceedingly low today. If you go a couple blocks in either direction, however, it's a very different story, and the ability to push rents is a very different story. So that said, San Francisco had tremendous office activity over the course of the last 6 to 12 months, and so you are seeing green shoots, you are seeing return to work, you are seeing all these things that are pushing interest in office. However, once again, I'll just caveat that when you talk to LPs from an interest level, I think the concern is, to show up to my board and recommend an office strategy as opposed to show up to my board and recommend a housing strategy. There's got to be a pretty big advantage to why I'm doing one or the other.
So another area where the bloom was off the rose for quite some time was retail, but retail is quietly becoming more interesting to institutions. What's the drawing card? What's drawing capital back, and why is the value add opportunity set still pretty narrow in that sector?
Yeah, I think retail is definitely a little bit of the flavor of the month for sure, and I think it comes down to the fact that fundamentals are simply really hard to ignore. Like in candidly, the national availability was about 5% at mid-year, and construction completions were at record lows. Nothing has been built in retail of mass, if you will, for years. And so that supply question, and this is interesting. I hearkened to a conversation I had with a client years ago that said, I want to buy where you can't build anything anymore. So meaning that whether entitlements or the or just the density requirements, et cetera, were just so fine. And this, by the way, that's not a rocket science type of comment. But if you really think about the supply equation, if entitlements, if the barriers to entry are too great to build more, then or the current supply situation is such that it's so compelling, that's what's happened in retail. The new supply has just been non-existent, and you now have retailers that are expanding. I think the stat that I saw was over 70% of retailers planning to grow their physical plant in 2026. And that, in the combination of just an exceedingly tight supply, provides, a very strong investment appetite, or very strong investment thesis. I think the capital is also responding to your point. This isn't a secret. You've seen transaction volume, I think, grow over 25% in 2025 only in retail alone. And the reality is that most of that has been geared towards, whether it be grocery anchored or power or strip and lifestyle formats, and that's certainly not the big malls of yesteryear. But the value add opportunity set, to your question, I think is a bit narrow, because rent growth hasn't been, as robust as it has been in other property types. You're still, I think, only around 2.5% on average. Certainly, there are pockets where that may not be the case, but on average. And so there may be a pocket where there's a development pad out front where you could really, you could develop for a higher yield or something along those lines that could get you to those value add returns. But really, this comes back to what I said before. Talk about a property type that is just durable income. You have stable income, and most of it is in a core plus type of story, than rather that broad value add type of strategy.
Over a year ago, most property owners were reeling from the rising cost of insurance. But surprisingly, insurance is one area where your mid-year review actually got a little more benign in the short run. Do you think that relief will last? And if so, why?
I think, it did come down in 2026. And however, I think long term, the wildfire risks, just overall threat of hurricanes, all of these type of things, the increased overall climate changes are going to continue to push it high. We may not see the drastic increases like we did, as quick as we did, but generally speaking, our belief is that you're going to continue to see the climate data pointing you to the fact that we are going to have increased intensity, whether it be wildfire, storms, et cetera. And so, that, in our view, is that we will continue to see insurance premiums rising.
Now, you and your colleagues at Park Madison recently described real estate as an AI immunity trade. What do you mean by that? And why does that matter for institutional allocators?
I think it's what we meant by it is, regardless of how quickly AI changes the economy, people are still going to need a place to live, to work, and to play. And that, in our mind, gives a kind of innate resilience relative to the other sectors, which may have much more direct impact, or be directly disrupted by AI. In that sense, actually, real estate could be both, serve as a beneficiary of the digital infrastructure, the data centers that we talked about, but also demand for just a broader portfolio diversifier in an AI-dominated market. So, I think the reality is we were having internal discussions recently about this, and my colleague and our CEO, Nancy Lachine, was saying that, the reality is AI, or real estate, really is that diversifier, because it diversifies against all the other AI tech heavy exposures in an institutional, outside of real estate, in an institutional investor's portfolio. So all the venture opportunities in PE and/or other things that are being the SaaS software, things along those lines that really are going to be AI impacted. Whereas real estate, may be a little bit more of a hedge in the sense of this is, once again, a cash flow, inflation protection, operational value creation, rather than and so maybe on a go forward basis, we can, rather than asking real estate to compete against AI, it can be really that broad-based diversifier in the overall portfolio.
Some of the people listening into this will be private wealth advisors, and the question they might be asking would be, Jack, you're saying it's a diversifier, but I have to advise my clients, and my clients are going to be asking me why I should be actually lowering their overall portfolio returns by reducing their exposure to the traditional 40-60, fixed income to equity portfolio that's delivering mid-teens. What's the argument there?
I think meaning that you're lowering your real estate allocation or lowering your...
No. I mean, the wealth advisors are, if they come in and say to their clients, hey, you ought to diversify into real estate, they're actually asking them to reduce their overall returns right now because they're getting mid-teens from the traditional 60-40 split.
Yeah. You could point back to the dot-com bubbles. You could point back to a lot of instances in history where investors lost sight of portfolio allocation and portfolio modeling. And I think that the reality is using real estate, we invest as institutional investors. We looked at a 30 to 50-year time horizon, right? And you're setting your allocations for that overall time period. There will be times where you can strategically over and underweight certain sectors and certain times at certain times. But generally speaking, you're setting a long-term profile. Real estate still has a role in the portfolio. It still is, should be somewhere between equities and bonds. And that's, equities have been on a tear and real estate is catching up. I think that now, as we've talked a lot about, we've seen positive performance out of the NPI, we've seen positive performance out of the Odyssey, and a real appreciation performance, right? Not simply the income side of things, but real estate holds a role in an institutional portfolio. And as an institution, and I know we're talking about private wealth and it's a little bit different, but you need to maintain portfolio theory and portfolio construction theory and maintain vintage year diversification in the execution of that portfolio construction. So I think that, yes, you may take a little off the top from, the overall return, but the reality is the outcome becomes a little less binary, if you will, if in the good and the bad, if you're just maintaining that strong diversification within a portfolio and you don't have all this exposure to the AI and those exposures, whether it's in PE or equities, et cetera, and you have a more broad-based diversification. That would be my argument back. But reasonable minds can certainly differ.
So, in closing, if you had to give the institutional investors and their advisors and their investment managers and operating partners one practical takeaway for allocating capital in the second half of 2026, what would it be?
Yeah, if I had a crystal ball, I would really like it, but I think I would go back to 2009 to 2012. Were some of the best performing private equity real estate vintages ever in 30 years and decades. And if you use that as simply a data point to say that in periods of discomfort, really great opportunities can emerge. And one of the biggest lessons learned from that period was that vintage year diversification really did matter. If you simply sat on your hands and said, I'm too nervous to do anything, and you missed out on those tremendous vintage years. Now, all else being equal, you need to have the capital back in order to redeploy it. So I can understand that argument as well. But the reality is in our view, there will be tremendous opportunities right now. If we look back at that 2009 to 2012 period, very, very strong returns in a very similar scenario to what we have today. Real estate is repriced. And so we should be back out in the market. So the best opportunities in our mind remain in sectors where the long-term demand is still intact and that new supply is difficult to bring online. And where, once again, durable income, cash flow, inflation protection makes sense to you. So in our minds, it's housing. It's as we discussed, manufactured housing or build for rent. It's in industrial, in more of those automated powered sites or last mile infill sites. It is in, and then dislocation opportunities that do present themselves. So have capital presented or exposed or ready to be deployed in an area where you're seeing dislocation. Where, for example, in New York City, as we talk about office, but talk about all the other opportunities in New York City and multifamily. There are folks that are coming up against debt maturities that have to move things, and so to having capital exposed and ready to invest in those type of opportunities is also another very strong investment opportunity today. So I think it's be selective. Real estate is still attractive, but we have to be a little bit more selective, and liquidity is improving as we sit here today, and hopefully that then spurs a lot more capital deployment, if you will, for the rest of the year.
Great. Well, thanks, Jack, for sharing Park Madison's house views with us today. We really appreciate the insights. Thank you all for tuning in, and hope you'll join us for next quarter's house views.
Thanks, Jeff. Greatly appreciate it. Very nice to see you and spend time with you.
Take care.
Thanks.
Okay.